Assalamu alaikum, everyone. Thanks for joining us today. We wait a couple of minutes to let other audience to join us. Inshallah, I will start to cover the subject. Okay, it's 3:33. Bismillah ar-Rahman ar-Rahim. Assalamu alaikum. I'm Sajjad, a financial advisor at ShariaPortfolio Canada. I hope you're doing well. I speak to you from Vancouver. Here is 3:33, and I hope the information that I provide for you would be beneficial for your life. I'm with ShariaPortfolio since 2021, and my master is in finance, and I'm a MBA holder. Today, I'm gonna talk about how to save on taxes with registered accounts and how you can maximize your saving RRSP, TFSA, RESP, and FHSA. First of all, a quick disclaimer. The only purpose of this webinar is educational purpose. I don't give you any advice. You know that people has a different situation, so you should go to talk with your financial advisors, or if you like, you can book a meeting with me. At the end of the slides, I would share the barcode. You can scan the barcode and book. And the information in these slides, as of today, July 31, 2024, is accurate, and you can use these rules. For introduction, for everybody that live in Canada, they need to save money for future, maybe for when they are retired, maybe to buy a house, maybe to go to Hajj, buy a car, or for your children, everything. So you need to have saving. In addition, we have inflation. Because we have inflation, not only you have to save your money, also you should to invest your money and let grow up your money to save your purchase power. As you know, in Canada, tax is progressive. Progressive means if you earn more, you have to pay more tax. So you should find some ways that you can save your tax, and you know about registered accounts, the accounts that government provide for people to save tax and use them for the future, for example, for retirement or for educational purpose or other things. So you need, if you want to live in Canada for a long term, you need to know about registered accounts and tax in Canada. Today I gonna talk about 4 registered accounts: RRSP, RESP, TFSA, and FHSA. We have more, but I'll cover these 4. The first registered account is RRSP, registered retirement saving plan, that the purpose of this account is save for retirement with tax advantages. In your RRSP is for the people that live in Canada, more than 18 or some province 19 years old, and they have job. And every year you can contribute 18% of your earned income in one account, RRSP account, and you can keep it in cash or invest this money. As I told you, you need to invest the money. 18% of your earned income. Why we say earned income, because for example, if you earn dividends or capital gain from your investment, you cannot contribute 18% of that amount to your account. But if you have a rental property, yes, you can. You can also contribute 18% of the rental property that the rents that you receive, and to your RRSP. And if you don't have money to invest, to save to your account this year, you don't worry, because the unused contribution rules carry forward to the next year, and next year you can contribute to your RRSP account. The main goal of this RRSP is for retirement, but in two cases also you can withdraw money. The first one is home buyer plan, that you can withdraw up to 60,000 from your RRSP account, pay the down payment or related costs for first home buyers, and you have to pay it back to your RRSP account in 15 years. So you can withdraw 60,000, your spouse can withdraw 60,000, and you can pay 120,000 for down payment. The next one is Life Learning Plan, or LLP, that you can withdraw up to 10K per year for 2 years, 20K, and you can pay for your education or yourself or your spouse, and you have to pay it back to your RRSP in 10 years. So as I told you, the main purpose for retirement, but in two cases, you can withdraw from your RRSP account without any tax transaction, and you don't need to pay tax for this withdrawal. What are the benefits of RRSP? The first one, the contribution room reduce taxable income. It's tax deductible. It means, for example, if your earned income is 2024 is 100,000, in 25 March you want to file your tax, and if you contributed, for example, in 24 10,000 into your RRSP, you only pay tax for 90,000, not for whole 100,000. And it's tax deferral. It means that when you receive dividend or capital gain into your account, in your RRSP account, you don't need to pay tax every year, because it's tax deferral. Whenever you are retired and you want to withdraw the money, you have to pay tax for the principal of the money and for the earnings. Also, some employers in Canada match your contribution to your RRSP, usually 3% to 5% of your paycheck. If, for example, you let your employer to deduct 3% of your paycheck and contribute to your RRSP, also your employer contribute that amount, 3% to your RRSP account. How you can open RRSP? Just go to financial institutions like banks or other financial institutions like ShariaPortfolio Canada. You can open. You need to have a SIN number, as I told you, resident of Canada, and you have job. We have three kinds of RRSP. Individual RRSP. When you open individual RRSP, you contribute to your account and you can withdraw from your account. We have spousal RRSP also. In RRSP, spousal RRSP, Your spouse opened the spousal RSP, you contribute to the account, but your spouse can withdraw the money. The benefit of this account is when one of the spouse has more income, can contribute to the account, and the other spouse that has a lower income and would be in a lower tax bracket, when we throw the money, pay less tax. And group RRSP, that employers open group RRSP. When you open the account and complete the application, contribute to the account, and you have a limitation, as I told you, 80% of your account, and you can contribute to the account from March to February. It's not from January 1st to last of December. No, the date for RSP contribution start from March to last day of February. And then you can decide where you want to invest this money, in stock, ETF, mutual funds, keep it in cash, or other things. The next registered account is TFSA, tax-free saving account. That the purpose of this account for save for any purpose. And it's tax-free. For example, if you, contribute to your account 5,000, invest this money, and 5,000 grows up to 7,000, you don't need to pay tax for 2,000 because the account is tax-free. And whenever you want, for any reason, you can withdraw the money from your TFSA. Maybe for Hajj, maybe buy a car, maybe for everything. And contributions are not tax deductible. As I told you, RSP contributions are tax deductible, but TFSA, no. It means that you contribute to the account by after-tax money. The benefit of TFSA is tax-free growth, no taxes on investment, and whenever you want, you can withdraw the money, and when you withdraw the money, you don't need to pay any tax. And TFSA and withdrawal from TFSA doesn't have any impact on federal benefits like GIS, Guaranteed Income Supplement. How you can open an account? Choose a financial institutions, complete the application form. In RRSP, to eligible for RRSP, you have to live a residential of Canada, have job, 19, 18 years old. But for TFSA, if you live in Canada and you are 18, 19, you don't need to have job. And it's the same contribution limit every year for all the Canadians that live in Canada. If you leave country, you cannot use your room. And when you contribute to the account, you can choose where you want to invest: stocks, ETFs, mutual funds, and etc. The next account is RESP account, Registered Educational Saving Plan. That the purpose of this account for childs and for post-secondary education of childs. The contribution, RESP, you open the account for your children. If you don't have children, so you cannot open RESP. You contribute to the account, and the government match your contribution 20% up to $500 per year. For example, if you contribute 1,000, the government match your account 20%, it means 200, and you have 1,200 into your account, and you can invest 1,200. If you contribute 3,000, 20% means $600, but the government only, the maximum grant per child per year is 500, so you have 3,500 in your account and you can invest. Contributions are not tax deductible because you contribute with the after-tax money, and the money grows up, and you don't need to pay tax for dividends and capital gains every year. When your children, they're gonna withdraw the money. When they withdraw the money, they have to pay tax. You already paid for the principal of the money. They only pay tax for the grant and the earnings. What are the benefits of RESP? The first one is CSG, that when you open the account, contribute to the account, the federal match your contribution 20%, up to 7,200 during 17 years. You only can, the children can only receive the grant in first 17 years. And each year you can contribute 2,500 for the current year and 2,500 for one of the previous years that you missed the CSG grant. We have CLB, it's for low-income families that the government contribute 500 to the account for the first year and 100 per year for 15 years. In total, it's 2,000. So if you are from a low-income family, you can open the account and you can receive CLB even if you don't contribute to the account. And the third grant is provincial grant. Some provincial like Quebec or BC, for example, in BC, BC government pay one-time 1,200 grant. If you live in BC between years 6 and 9 years old, your children can apply for this and receive from the government. As I told you, it's tax sheltered. It means you don't need to pay tax until the children wants to withdraw the money. And when they withdraw the money, you already paid the tax for the principal and for the contributions, because your children at that time are students. They don't have enough income. So they will be, they would be in a lower tax bracket, and maybe their income is less than 15,000. So actually they don't pay any tax for that amount. And flexibility, it's not for tuition, maybe for related, cost related to education. They can withdraw and pay for that amount. How you can open RESP? Just go to a financial institutions and complete the forms, and the company, usually the financial institutions, apply for the grants for you and make the contributions. You and your children have to have SIN numbers. So if your children doesn't have SIN number, you have to first apply for SIN number, then open RESP account. For all the registered accounts, if you have a work permit or a study permit, you can open. If you have SIN number, you can open registered accounts. Whenever you contribute to the account, the government match your account, pay the grant, and you can invest the money in stocks, ETF, mutual funds, or etc. And when your children go to university, they can withdraw. If they don't go to university, or if you want to transfer some of them to other child, you can. But it's not the subject of this webinar. We already had a webinar about RESP. You can go to our YouTube channel and watch the recorded one. The last registered accounts that I'm gonna talk about today is FHSA, First Home Buyer Saving Account. This account is only for first home buyer. If you remember in RSP, I told you about, I speak about home buyer plan. Home buyer plan is also for the first home buyer, FHSA for the first home buyer. and you can contribute to your FHSA up to 8,000 per year for 5 years. After 5 years, you have 40,000. 40,000 you, 40,000 your spouse, 80,000 you can pay for down payment or costs related to your home. 80,000 from your FHSAs, 120 from your homebuyer plan. To get totally 200,000 you can withdraw and pay the down payment and buy a house with FHSA and RRSP. The benefit of FHSA, it's tax deductible. FHSA contributions reduce taxable income like RRSP. So, for example, if you have, for example, 100,000 income in 2024, and you contribute 8,000 to your FHSA, you only pay tax for 92,000 to the government, not for 100,000. Whenever you buy a house, you can withdraw the money and buy a house, and again, you don't need to pay any tax. So no taxes on withdrawals. And it's like TFSA, it's tax-free saving account. So if you contribute 8,000 to your account and it grows to 10,000, you don't need to pay any tax for 2,000 earnings. How to open an FHSA account? Go and choose financial institutions, complete the application process, make contributions, and start to invest. In all registered accounts, it's your responsibility to don't invest to more than your limit. In RRSP, because TFSA, RRSP room that you can see into your CRA account, they only update in January. So, for example, if you contribute in December, in February, in March, they don't change the number. Number only change one time in a year. It's not, they don't update the account every time that you contribute to the accounts. As I told you, date for RSP contributions from March to February next year, but for FHSA, RESP, and TFSA, it starts from January 1st to December, to the last day of the December. Comparing RRSP and TFSA, which one is suitable for you? RSP, as I told you, is tax deductible contributions and tax deferred growth, taxed on withdrawals. As I told you, in RRSP, when you contribute to the account, you don't need to pay tax for that amount, and invest the money grows up. Again, you don't need to pay tax every year because it's tax deferred. Whenever you are retired, you want to withdraw the money. At that time, you have to pay tax for the principal of the money and for the earnings. At that time, you are retired, you don't have income or maybe lower income than now, so you would be in a lower tax bracket and you can save the tax and pay less tax than now. TFSA account is not tax deductible, so you contribute with the after-tax money, but it's tax-free growth. It means if you contribute 5,000 in your TFSA and it goes up to 7,000, you don't need to pay tax for 2,000 growth. And whenever you want, for any reason, you can withdraw from your TFSA without any tax transaction. The purpose of RRSP is for retirement, and for TFSA, it's flexible saving for any reason you can withdraw. And just for RRSP, I told you in 2 cases you can withdraw: for homebuyer plan if you are first homebuyer, and for LLP, for educational purpose for yourself or your wife, not your children. In the event of bankruptcy, your RRSPs are generally protected against most creditors. So if you have money into your RRSP and you bankrupt, you don't have any problem. They cannot seize your RRSP account. But in your TFSA are available for creditors to see. For RRSP withdrawals, impact on income. When you are retired and you withdraw money from your RRSP account, it causes that you increase your income. And when you show income to the government, you have to pay tax on that. So when you are retired and the government want to pay GIS to you because you have income, it impacts on GIS amount. But for TFSA, no. TFSA and TFSA withdrawals doesn't have any impact on benefits from government when you are retired. Like old age securities, OAS, guaranteed income supplement, GIS, or employment insurances, EIs. Comparing RESP and FHSA, RESP only for educational purpose. You contribute to the account. For your children, when they go to university, they can withdraw the money and they don't need to pay it back. And the grant is free. You don't need to pay back the grant to the government. In FHSA, the goal is for first home buyer to save money to pay down payment. It's tax deductible like RRSP. It's tax free like TFSA. And whenever you buy a house, you can withdraw the money and pay the down payment. And you don't need to pay it back to the FHSA. No, when you withdraw the money, pay the down payment, close the FHSA account. Tax saving for RRSP, you should contribute to your RRSP account every year up to your limitation, because it's tax deductible. First of all, decrease your tax, and if you you pay tax monthly at the end of the year because you contributed to your RSP, the government refunds some of the taxes that you already paid. And also because it's tax deferred, you can let your money to grows up during the year also. And when you contribute to the RRSP, you can go to a lower tax bracket and pay less tax to the government. For TFSA, tax saving with TFSA, earnings grow tax free. So whenever you contribute, the money grows up. So if you contribute earlier, you can give your money more time to grows up. And whenever for any reason, you can withdraw the money and you don't need to pay any tax on that amount. For RSP, you have to have job and residential of Canada and 18, 19 years old. But for TFSA, only if you live in Canada, you can open TFSA account and contribute to the account. Tax saving with RESP, whenever you contribute to the account, the government pay grants. So if you have money, you can contribute to the account in January and give more time to your money to grow up. And it's tax-free growth until withdrawal. So you don't need to pay tax for their earnings every year whenever your children go to post-secondary university or, for example, college, they pay you, they have to pay the tax for the government. And one important thing, when you want to withdraw money for your children from RESP, you should withdraw EAPs first, then PSE. What is PSE is your contribution to the RESP account. EAP is the grant and the earnings of the money. You should first withdraw EAP from the account. Why? Because when the children want to withdraw the money from RESP accounts, they have to be student. So, for example, if after 1 year, 2 year, your child say, okay, I gonna stop and I wanna leave the university. At that time, if still you have grant in the account, the government will withdraw the money. But if you start from EAP, from the grant and earnings, no. The remain amount is PSE and are your contribution, and you can withdraw without any tax transaction. So you should withdraw EAPs first. Then when finished, go to PSE. Tax saving with FHSA. FHSA, as I told you, like RSP is tax deductible and it's tax free, like TFSA. So every year you can contribute 8,000 into your account for 5 years, 40,000. But as you know, FHSA start from 2023. If you opened FHSA account in 2023, now in 24, you have 16,000 contribution rule, 8,000 for 23, 8,000 to 24, and you are in the second year of your FHSA account. But if you didn't open account, you can open this year. If you even maybe you don't have money to contribute, but you can save the contribution room. But you need to know that only 8,000 of your contribution rooms carry forward to the next year. In RRSP, carry forward every year. In TFSA, carry forward every year. But in FHSA, the maximum carry forward money is 8,000. So if you opened the account last year, you didn't contribute, and you don't have money to contribute this year, next year you have 16,000 contribution room, and actually you missed 8,000 contribution room into your FHSA account. A strategy for maximizing your RSP contribute up to the annual limit. Each year contribute how much you can if you have money. But as I told you, it's your responsibility, and don't contribute more than your limit, because you have to pay penalty for that. And if your employer also match, do it, because it's extra money from your employer. And because you invest your money for when you are retired, if you're, for example, 20 years old, now you have 45 years to invest money, you can go to maybe high risk, and because you want to invest for a lifetime. For TFSA account contribution annual limit, as I told you, the government every year announced the limit for TFSA for all the residential. It's the same, and you can contribute to the account and let the money grows up based on your goals and your time horizon. If you want to withdraw the money next 2 years, you should go to a short term. If you want to invest for your children and you have, for example, 20 years, you can invest in long-term portfolios. Strategy for maximizing our ESP account: contribute early to the account. As I told you, you can if you have money, you can contribute in January. You can contribute monthly, semi-annually, or whenever you have money, you can contribute. But when you contribute, the government pay the grant. So if you have money, contribute in January and let the money grows in 12 months. And as I told you, start to withdraw the money from EAPs and then PSEs. PSE means your contributions, and whenever you want, you can withdraw. Again, if you have any questions, we already had a webinar about RESP, about withdrawals, how you can transfer RESP, how you can, if you close the RESP, how you can withdraw the money, about the penalties, everything. You can go to our YouTube channel and watch the recorded webinar. A strategy for maximizing FHSA. Contribute up to the annual limit. As I told you, 8,000, or if you have 8,000 from last year, 16,000. It's your responsibility. Don't contribute more than your limit and let the money grows up, and you have planned timing to buy a house. You know that in 5 years, you have 40,000 in your account, and you can have a plan to buy a house. I covered 4 registered accounts. We have more, but I only covered, the popular account are RSP's TFSA, FHSA's new account from last year, and RESP account for the families who they have children. For conclusion, I provided some steps that could be help you and beneficial for you if you want to start to do investing and saving. I advise you to start if your employer offer you RSP or RPP matching. Ask them, because as I told you, it's extra money. For example, from each paycheck, they deduct 3% from you and contribute to the RRSP, and the employer are also contribute 3%. So it's extra money. So firstly, if the employer offer, apply for it and get it. The second one is the second step is pay off the credit card. If you have to pay money to your credit card, you pay it, because usually the interest rate is high and 19%, 20%. So go and pay off your credit card. And third, if you have any other loans that in high interest rate, pay off them, but for example, if you purchase a car and the loan is 5%, 6%, you don't need to pay off that loans, because if you invest your money, maybe you can earn more and it can cover the interest rate. When you don't have debt, you can provide one emergency fund for yourself. Usually we advise to have emergency fund for your life costs for 3 months at least. And if you have extra money, you can go to step 4 and open RESP account. If you don't have children, waive this step and go to step 5. Open RESP account and contribute 2,500 to receive full grant from the government. It's 500 per year per child. If you have 2, you can receive 2. In RESP account, also let me mention that we have several kind of RESP. Individual RESP, it means one account for each child. We have a family RESP that you can open one account for 2, 3 children. And for example, if one of them go to, for example, medicine school, business school, need more money, can withdraw more money from your contributions, not for grant. The grant is different. And when each of them receive grant, they have to use their grant and cannot reach out to the to the siblings. And we have also group RESP that usually the schools can open and contribute for all the children. If you have extra money, you can open FHSA account, and if you are first home buyer. If you are not first home buyer, go to step 6. You can open FHSA. If you have 8,000 contribution room, contribute 8,000. If you have 16,000, contribute 16,000. And in step 6, contribute to your TFSA or RRSP. You usually ask clients, I have to start with RRSP or TFSA. It's different based on your situation. That's why I put RRSP and TFSA contributions in one step, because based on your goals, time horizon, you can find which of them is suitable for you. Then if you have extra money, you can back to your RESP account and contribute up to 40,000. As I told you, the maximum for RESP is 40,000. But if you want to only receive the full grant, you have to contribute 2,500 per year. But if you have money more than that, you can contribute and let money grows up, and you don't need to pay tax every year for that. Again, if still you have more money, you can open a non-registered account, invest the money, let's goes up. But because it's non-registered account, every year you have to pay tax for the dividend and capital gains. Common mistake to avoid. The first one, over contributions. It's your responsibility. As I told you, CRA only changed the numbers for TFSA, RSP, and TFSA and RSP only once in a year. So it's your responsibility. And also for FHSA, you cannot contribute more than 8,000, or if you have contribution from last year, 16,000. And for RESP, during the 17 years, you can contribute up to 50,000, not more than that. 50,000, your contributions. Maybe your money grows up to 100. And also you can receive 72,000 from the government, CSG, and also 2,000 from CLV. Again, your contribution has to be less than 50,000. And if you missed 1 year in RESP account, you can contribute 2,500 for this year, 2,500 for the one of the previous years that you didn't receive, and you can receive 1,000 grant from the government. About the unused contribution rooms, as I told you in RRSP, unused contributions will carry forward to next year. In TFSA, also carry forward to next year. FHSA, carry forward to next year up to 8,000. But into your TFSA, for example, if you withdraw the money from, you need money, you can withdraw. You withdraw the money, for example, in August. If you want to pay it back to your account and you don't have contribution, you have to wait until the January 1st. You cannot pay it back, right, for example, next week, next month, in that year. You have to wait until January 1st. Okay, now let's go to who we are and what we do. As I told you, I'm financial advisor at ShariaPortfolio Canada. ShariaPortfolio offers managed investment solutions that help Muslims achieve their life goals while honoring their personal values. ShariaPortfolio US, founded by Naushad Virji in 2003 in the USA, and is licensed from SEC. In ShariaPortfolio, We have advised clients in Canada, ShariaPortfolio Canada, ShariaPortfolio in USA, and we have ShariaPortfolio Global Wealth. In Canada, we registered now in 4 provinces: Ontario, Alberta, British Columbia, and Quebec. You can open registered accounts and non-registered account in ShariaPortfolio, and you only contribute, and we invest the money for you in a stock market in halal ways. And we only have halal options. Some banks, if you go, they have halal and non-halal, but in ShariaPortfolio, we only have halal options. We work with Fidelity, and client assets are custodied with Fidelity Clearing Canada, the Canadian affiliate of a corporate group that is one of the 4 custodians globally, operating in 11 countries across North America, Europe, Asia, and Australia. We have 2 services in ShariaPortfolio Canada, active and passive. The active is a primary solution for comprehensive wealth management, and passive, the economic solution to halal investing. That in next slides, I will explain more about active and passive. When we say halal investing, we have several standards in Islamic finance. That in ShariaPortfolio, we work based on IOFI standards. IOFI is the accounting and auditing organization for Islamic financial institutions. Their mission is standardization and harmonization of international Islamic finance practices and finance reporting in accordance to Sharia. We have a IOFI board. If you want to have more information, you can go to their website. When we say ShariaPortfolio work in halal investing, it means we work based on IOFI standards. They have some standards. For example, one of them, we cannot invest your money in these 8 industries: gambling, alcohol, pork, weapons, high leverage like banks and other financial institutions, tobacco, adult entertainment, music, cinema, and broadcasting, and some leverage that I don't want to talk about. For example, cash or cash equivalent and receivable our assets should be less than 30%. These ratios we can find about their financial statements. In Islamic finance, we can invest your money in stocks, sukuk, mutual funds, and ETFs that are eligible Sharia compliance. We have several ETF. If you go to banks, they have ETF. But in ShariaPortfolio, we only put halal stocks in your ETF. But if you go to banks, firstly, they put bonds in ETF and mutual funds. That bonds are totally haram because work based on interest. And also, we cannot invest your money in preferred shares because preferred shares pay fixed income and are not Sharia compliance. As I told you, we have passive and active service. In passive service, the minimum to open the account is only 1,000. You can open registered, non-registered account, contribute, and start with 1,000. We have 6 portfolio models from sukuk, conservative, and at the end, aggressive one. Aggressive is high risk, and also our expectation is high return. In all portfolio models, we invest your money in 5 ETFs that are registered company. Our sister company, SP Funds, registered in New York Stock Exchange, SPUS, SPRE, SPUS, SPT, SPW in equities, SPRE in real estate, and SPSK in sukuk. When you open an account in each portfolio models, we invest your money in 5 ETFs, but with different combination. In aggressive models, a big portion of your money invests in equities and a small portion in sukuk and real estate. On the other side, in conservative and sukuk, we invest a small portion in equities. We have also the management fee for passive service is only 0.5%, 0.5% that we divided by 12 and charge you monthly. We also have active service. In active service, the minimum is 100,000 based on your goals, time horizon, and risk tolerance. We make customized portfolio for you, and we invest your money in ETFs and individual stocks. And you can connect with our portfolio managers, ask your question. Maybe you ask to maybe invest your money, 5% of your portfolio in ETF related to Bitcoin or maybe gold. We can do it for you because it's your account, and in active service, we provide a full service wealth management for you. We have a team of portfolio managers that can help you, and also financial advisors. Also, you can open the account for your companies. Okay, good. I covered the subject of webinar, and now if you have any question, please type your question in Q&A part. We have 2 questions from Brother Muhammad. So please tell if RESP withdrawals is taxable. Yes, RESP withdrawals, as I told you, withdrawals divided by 2 parts, PSE, that are your contributions. When you withdraw PSE, you don't need to pay tax because you already paid the tax. But if you withdraw from your the grant and the earning PSE, you have to pay tax because you didn't pay, and your children has to pay. And when they don't have they don't have job, or they have job, they are low income, actually they would be in a lower tax bracket than you, and they pay less tax. So in total, if it's from PSE, you don't need to pay tax, but from PSE, the children have to pay tax, but from the contributions, no, they don't need to pay. Contributions, no. Grant and earnings, yes. The next question is, please elaborate on benefits of contributing to spousal RRSP. As I told you, in RRSP account, you open the account, and whenever you are retired, you can withdraw the money. Spousal RRSP, your spouse open the account. For example, I have job and I earn, for example, 100,000 per year, but my wife doesn't have job. For example, housekeeper, or maybe she has, but low income, 50,000, less than me. So we can open spousal RRSP for my wife, and I can contribute to the account, and it deduct from my contribution room. And my wife only can withdraw the money. And my wife, when retired, my wife can withdraw. At that time, because he's in a lower tax bracket than you, she can pay lower tax than you, and you can save tax and less tax to the government. Yeah, those are 2 questions that I received. If you have more questions, you can type, and also you can scan the barcode if you like to have a meeting with me. Or you can check our website, ShariaPortfolio.ca. My phone number is 604-727-1395, and my email is Sajjad@ShariaPortfolio.ca. All our advice and our consulting sessions are free. You can talk with us, ask your question, all free. If you like, you can open an account. If you don't like, you can go to other financial institutions. I know the one question, I know bit off topic, but would you be able to explain? Actually, it's not in the subject of the question, but we have just one thing that I told you that about passive and active. Passive income means you don't need to work to receive the income. But active means you have to work. If you don't go to your job, if you don't go to your workplace, if you stay at home, they don't pay you income. So when you are retired, if you don't have any saving, so you don't have passive income. And you cannot work maybe because you are old, so you don't have active income. But if when you were young and you saved tax before save into your RSP account or other or TFSA account, you can withdraw the money, you can let it save, and you can withdraw from dividends, capital gains, and the money. It's passive because you can stay at home and withdraw the income. It's passive income. In RRSP account, it's 18% of your earned income. It means you cannot pay 18% of the passive income. For example, if you receive dividends or capital gains, you cannot contribute 18% of dividends and capital gains. The only exception in that is a rental property. If you have property and you receive rent every month, at the end of the year, you can contribute 18% of that amount to your RSP account. Okay. Yeah, as I told you, in ShariaPortfolio, we would happy to help Muslim to reach their financial goals in halal way. We registered now in 4 provinces. We have a team of financial advisors, a team of portfolio managers that can help you answer your question. You can open account in passive service. The minimum is only 1,000. If you have these accounts in bank or other financial institutions, just contact with us, send a copy of the last statement. We will contact them and ask them to transfer. The management fee in passive service is only 0.5% per year, and in active it starts from 1.5. And if you invest more, it could decrease also. Yeah, it's now almost it's 4:32 in Vancouver. You can open an account. All the processes are online. You can open the account and all of them is signed. We don't need to have an in-person meeting. But if you have, we have office in Vancouver and office in Toronto, if you like. Yeah, thank you for joining today. I hope the information that I provided for you would be useful and beneficial for you guys. Thank you so much and enjoy rest of your day. Thank you. Bye. Assalamu alaikum.